Hi everybody, Stuart Kiehne, President of Redwood Mortgage Services, and I'm here today to discuss and kind of clarify for those folks that don't know it, what are closing costs for buying a home. So, I often refer to closing costs similar to sales tax. In many states in our grand nation, you go to the store and you buy a $100 item and you're going to pay anywhere from an extra $4 to $7, $8, or $9 in sales tax. Buying a home is kind of similar. The fees are just broken down very much differently. Okay, so I do know in the state of Maryland, typically on a resale property, if you are buying a home here, you will end up spending approximately anywhere from 3.25% to 4.5% of the price of the home on closing costs. So if you were buying a $100,000 home, then in addition to whatever down payment you may need, you would need money for your closing costs. Whether you're paying them or if the seller's paying part of them, you still need some for your share of closing costs. So, but on that $100,000 home, that would mean that you need anywhere from $3,250 to $4,500 to pay those closing costs. Okay. So the question is, what are the closing costs? Well, closing costs are made up of a number of different things. Okay. There are lender fees, there are title company fees, and then there are typically recording fees for the government entity that handles the land records there. And then there is something called escrow. Okay, and we'll talk about that in a minute. Anyway, lender fees are typically things like an origination fee or underwriting fee. There's an appraisal associated with that the lender charges, but it's typically paid directly to the appraiser, so that's not really something that the lender charges, but there is an appraisal cost associated, but once again, that money goes to the appraiser. Okay, so and then the credit report fee and tax service fee and maybe a flood certification. Minor items typically in the grand scale of that transaction. Other lender fees that you could possibly pay is discount points. And a discount point is actually typically your choice because you've locked in at a certain rate and you've chosen the lower rate, so you're paying a chunk of what we call prepaid interest, if you will. But it's considered a discount point because you're getting a discount on the interest rate because you're paying some additional interest up front. Okay, and that's usually a math equation to figure out whether or not choosing a lower rate and paying a discount point makes sense for you. Okay, so don't go at that math all by yourself. Talk to your lender, us, or whoever you're dealing with, and trying to figure out if paying a discount fee makes any sense for you in the long range plan for how long you plan to be in the home. Okay, title fees. So title fees are the closing fee and or attorney fee for the settlement company. They're an independent group that is providing this service, and what they do is they collect the money, they collect our loan money, they collect your down payment money, they collect the closing cost money, and then they disperse all of that to the places that it needs to go. Well, they need to be paid for those services, and it's typical. And additionally, as part of that, not only are there their specific fees, but there's lender's title insurance and optional owner's title insurance. Okay, so we can get into all those details in a phone conversation, or you can always talk specifically to a title company to get more detail on that. Okay, that other item that I've mentioned previous in this video is escrows. You buy a home. In most jurisdictions, unless you're a disabled veteran, you have to pay real estate taxes, and you also have to have insurance on the home. Most of the time, those are escrowed with your mortgage payment. So if your monthly mortgage payment happens to be $1,500, let's just say, for the principal and interest on the loan, then we're going to take 1/12 of your insurance and collect that monthly as part of your payment. So that will be added. If the insurance is $100, that brings your payment to $1,600. If your real estate taxes are $2,400 a year, then we're going to collect 1/12 of that with your payment as well. So that brings your payment up another $200. That brings it $1,500 plus the insurance of $100 plus the $200 taxes. That brings that up to $1,800. So the reason we collect escrows is so that when your insurance is due, you don't have to pay that big bill. You send the payment, the invoice to us or the servicer, and we make sure that gets paid. The same with the taxes. It's important for the home to be insured, and it's important for the taxes to be current. Okay? Otherwise, your property could go to tax sale. That's not good for the lender, and it's not good for the homeowner either. So that's why those are escrow. In addition to those items that I just discussed, there are a few other items that are actually included in closing costs, but they're often added to your loan amount. So they're not considered additional cash to close, but they are costs of doing the transaction. For instance, if you get an FHA loan, there is FHA upfront mortgage insurance premium, and that is 1.75% of your loan amount, but it's added to your loan, so it's lent to you. Okay? If you're getting a VA loan, there's a VA funding fee, okay? And we can talk about VA funding fees specifically for VA buyers, but once again, that's added to the loan amount, okay? So it's not cash to close, but is considered a closing cost, okay? If you get a USDA loan, that also has a guarantee fee that is added to the loan amount. So while they may inflate or make your closing costs look like they're much higher, those items are not cash to close because they are added to the loan amount. So anyway, I'm happy to discuss closing costs with you and any other parts of the mortgage lending process or mortgage approval process. Do me a favor, give us a call. All my information is below, and we're happy to help. Thank you.